So hello all my dearest students of South India. I hope you all are doing good and I hope your studies are going great for your upcoming November 23 exams. So here we continue the legacy of discussing the past papers, past RTPs, past MTPs, which we have left in May 23. We are continuing for November 2023 exams. So till May 23, we have discussed around 19 papers. So we are continuing that discussion with 4 more papers, that is RTP November 23, MTP November 23 Series 1, MTP November 23 Series 2 and the past paper, that is May 2023 exam paper. So if we complete these 4 things, then we are up to date with all the latest discussion of all the RTPs, MTPs, exam papers, so on and so forth. And in all, we'll be completing 23 papers, which will be much more than enough for your exams. So without wasting any further time, let us start with the discussion. This is especially for you all, my dearest students from South India, who are willing to understand the income tax law in full English. Okay, so let us start with the first question. The first question is a PGBP question, question number 16. Till question number 15, there is an MCQ, and all the MCQs I have already discussed in a separate video of RTP. You can go and check that. Okay. So today we are more interested in the descriptive questions and not the MCQs. MCQs we have already discussed. Now the first question over here is the manufacturing assessee. This is a question of total income and tax liability, and you have to compute the total income and the tax liability as per the 115BAA. Be very careful. It is an alternative tax regime where you have to pay 22% tax, 10% surcharge and 4% cess. Okay. So you have to give the answer according to that. So assessee is a manufacturing activity. His profit is 180 lakhs, and therefore the first adjustment is assessee is paying some interest of 24 lakhs, and rather than paying that interest, assessee is settling that interest by issuing debentures. So I'm not paying you interest, but instead I'm settling the interest by giving you debentures. Is it allowed as deduction? The answer is no. Conversion of an outstanding interest into a new loan or into a debenture or any other security or any other instrument is not allowed as deduction. It is the amendment made by Finance Act 2022. You have to actually pay to the other person. Otherwise, it is not allowed as a deduction as per section 43B. Okay. Next one. The assessee is paying some, assessee has done, the assessment of the assessee is done, and there is a demand of 5,80,000 on assessee, which includes surcharge and cess. Whether this will be allowed as deduction. Finance Act 2022 has again clarified that the deduction of income tax will include the disallowance of income tax will include surcharge and cess also. You will not get the deduction of surcharge also. You will not get the deduction of cess also. It is an amendment made by Finance Act 2022. Next one, you are making some provision for gratuity. Provision for gratuity is disallowed. But if you have paid some gratuity, which you have paid in the last adjustment, 105 lakhs, that will be allowed as a deduction to you. But provision for gratuity is not allowed. It is disallowed. Okay. So 180 lakhs will be added back and 105 lakhs will be reduced. Next, you are incurring some expenses on foreign travel of directors. Your directors are going out of India. You are incurring some expenses on foreign travel, and they are going for business purpose. They are not going for any personal purpose. Therefore, it shall be allowed as a deduction under PGBP. Next, you are making some payment of more than 10,000 rupees in cash to a person in a day for buying some raw material. It is disallowed, 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 disallowed. It doesn't matter whether you are paying on 26 January or whether you are paying on 15th August or whether you are paying on 14th February, for example, or whether you are paying on 2nd October. It doesn't matter. Even on holidays, if you make the payments, 14th February is obviously not a holiday, but other days are holiday. Even on holiday, if you pay, the expenditure is disallowed. You have to make the payment by account pay check, account pay draft, ECS, and such other electronic mode. Next, there's a Japanese company who is giving you some kind of what? Online advertisement, and this Japanese company does not have a P in India. Therefore, you should have deducted equalization levy. It is an example of Facebook. A non-resident does not have a P in India, and that non-resident is giving you what? Giving you some services in respect of online advertisement. You are making the payment. You should have deducted the equalization levy. If you have not deducted the equalization levy, your 11 lakh rupees will be disallowed under section 40A1B. Next is corporate social responsibility expenses are not allowed under PGBP as per explanation 2 to section 37(1). Therefore, you have to add it back. Next, you are selling some vacant land on which 18 lakh long-term capital gains is charged, and you are selling this vacant land to a wholly subsidiary Indian company, wholly owned subsidiary, which is an Indian company. So this is exempt under section 47. So you will remove from PGBP, and under income from capital gains, you will show that as an exempt transfer under section 47. Next, you are making some payment to a university as a donation under section 35(1)(3), and that is given as a donation for social science purpose. That is generally allowed, but not allowed here because the assessee is following 115BAA. Assessee following 115BAA will not be eligible for what? Will not be eligible for scientific research deduction, social science, statistical research. All these deductions are not allowed. Okay. Next, you are paying some interim dividend of 65 lakhs. That is not allowed in PGBP. That is an appropriation. But there is some related adjustment over here. That is, you are receiving a dividend of 36 lakhs. So this dividend you will reduce from PGBP. Listen carefully, and you will show under IFOS. And whatever dividend you have received and in comparison, whatever dividend you have distributed within 1 month prior to the due date of filing of return, that will be allowed as a deduction. So you have received 36 lakhs and you are distributing 65 lakhs. So you will get deduction under ATM of 36 lakhs. Sir, do we get deduction of ATM under 115BAA? Yes. If you opt for 115BAA, there are 3 Chapter 6 deductions which are allowed. One is ATM, one is ATJJAA, and one is ATLA. These 3 deductions are allowed even for assessees covered under 115BAA. Next one is you are contributing, the company is contributing to employees pension fund approximately 15% of basic salary and DA in terms, but only 10% is allowed. Therefore, 60 lakhs is 15%. Therefore, 10% is how much? It is 40 lakhs. Therefore, 40 lakhs is allowed. Out of 60 lakhs, 40 lakhs is allowed. Therefore, how much is not allowed? 20 lakhs is not allowed. So, you have to add back 20 lakhs over here. Next, depreciation you will add back. Next, this adjustment I've already told you, this dividend adjustment. Next, donation to political parties generally allowed in ATGGB, but not allowed in what? 115BAA. Under 115BAA, this particular item will not be allowed as a deduction to you. Okay. Next, normal depreciation allowed. Additional depreciation not allowed under 115BAA. Next, unabsorbed depreciation is allowed. It is allowed because it is out of normal depreciation. If it would have been out of additional depreciation, then even normal depreciation, then even this normal depreciation, then even this unabsorbed depreciation would have not been allowed. Next, gratuity, and then you will compute the tax, 22% tax, 10% surcharge, and 4% cess. So it's a very good question. Next question, question number 17 is on TDS. So pay attention, please. What is happening over here? We need to find out the TDS and TCS implication in these cases. The first case is Delta is an Indian company who is buying some coal. So suppose if somebody is selling me some coal, then the seller is supposed to collect TCS under section 206C subsection 1. But if the buyer gives a declaration that I am going to use that coal for manufacturing purpose or for the purpose of generation of electricity, then the seller will not collect TCS. Here I am saying that only. See, Delta, the buyer is saying that I am buying the coal for manufacturing purpose. Therefore, the seller will not collect TCS under 206C subsection 1. This is the first thing. But the law says that if the seller is not liable for TCS, then you should check whether the buyer is liable for TDS or not. The buyer under 194Q is liable for TDS or not. Now, in this case, the buyer is not liable for TDS because this is the first year of the buyer. And in the first year of the buyer is never liable for 194Q because for 194Q to apply, you have to check the turnover of last year, and the turnover of last year should be more than what? It should be more than 10 crore rupees. If the turnover of last year is more than 10 crore, then only the buyer is liable for 194Q. Therefore, 194Q is also not applicable here. Last but not least, if the buyer is incorporated in the last year, that is in 2021, then whether 194Q will apply or not, then also it will not apply because then in that case, your last year turnover is exactly 10 crore. It should not be exactly 10 crore. It should be greater than 10 crore. Check it, please. So now let's move on to the next point. Next point is also on TCS. Now this is on TCS on motor car. Suppose here Sigma Limited, a car manufacturer, is selling some car to car dealers. So always remember, when a car manufacturer sell car to car dealer, then 206C1F is not applicable. There is a CBDT circular which says that if a car manufacturer sells car to car dealer, 206C1F is not applicable. If 1F is not applicable, then you have to first of all check 194Q, whether 194Q will be applicable. Now, in case of Epsilon, 194Q will be applicable because Epsilon's last year turnover is greater than 10 crore rupees. And Epsilon is also buying more than 50 lakh rupees cars. Therefore, 70 lakh rupees, 0.1%. That is in excess of 50 lakhs, you will deduct TDS at the rate of 0.1%. Now, in case of Omega, whether 194Q is applicable for Omega, 194Q will not be applicable. The reason is very simple because Omega's last year turnover is less than 10 crore rupees. Therefore, in case of Omega, Sigma has to collect TCS because Sigma's last year turnover is greater than 10 crore. Check, please. So, always in case of car, first check 206C1F. If 1F is not applicable, then go for 194Q. If 194Q is not applicable, then go for 206C1H. This is the order that you have to follow. Because between 206C1H and 194Q, 194Q will always win. It will get the priority over 206C1H. This is how you are going to supposed to check. Everywhere, if you are collecting or deducting TDS, you have to collect and deduct TDS over 50 lakh rupees. Up to 50 lakh rupees, you are not supposed to deduct or collect TCS, okay, and TDS. Next one is based on a Singapore airline case law, which I have already covered in the case law lecture. You can go and check. I have also done that case law lecture in English also for the recent 13 case laws which are added by the institute for November 2023. This case law talks about a very important thing, that is generally a commission agent earns two type of commission when they sell the tickets. One is a normal commission which is called as a standard commission. Another standard commission is a percentage of a ticket price. Okay, that is something which they earn. Second commission which they earn is supplementary commission, which is the difference between the price at which the agent sells and the price at which the ITA, that is International Air Ticket Authority, decides that price. So the difference between the two is called a supplementary commission. The question over here is, in that case law, I have explained properly what is exactly supplementary commission and what is exactly standard commission. So the question over here is whether the TDS will be deducted on both the commission under 194H. Yes, the Supreme Court has held that the TDS under 194H will be collected on both the commission, that is on the standard commission also and on the supplementary commission also, as per the Singapore Airline case law of Supreme Court. Okay. Next question is based on your updated return, whether updated return is applicable in the following cases. Now, the accounts of the assessee were audited for 2020-21 on 28th of December 2020, and assessee is declaring an income of 12 lakh rupees. And for 21-22, assessee is declaring a loss of 5 lakh rupees. Now, for the second year, that is 21-22, assessee wants to file an updated return declaring an income of 7 lakh rupees. Now, can the assessee declare an income of 7 lakh rupees? Now, from a loss of 5 lakhs, if you want to go to income of 7 lakh rupees, yes, you can go. If you want to file an updated return, you can go from loss to income. Loss to loss is not allowed, or income to loss is not allowed. But earlier you had a loss, and if you want to show as an income, you can file an updated return. Till when you can file? You can file till 31st March 2024. That is 2 years from the end of the relevant assessment year, you can file the updated return. Now the assessee is filing on 30th November, and because the assessee is filing in the immediate 12 months, therefore the assessee will be liable for 25% tax, additional tax on tax and interest. So assessee has to pay tax, assessee has to pay interest, and then on tax and interest, it has to pay 25% additional tax. Then, if the assessee would have filed the return in the last 12 months, that is after 31st March 2023, but before 31st March 2024, that is in the last 12 months, then the assessee would have to pay 50% additional tax on this particular case. Okay. So here only 25% tax, because the assessee is filing in the initial 12 months and not in the last 12 months. Now, what is the time limit to complete assessment? Now, the initial case, for the first year, the time limit would be 18 months, because for AY 2021, the time limit was 18 months on the end of relevant AY. In the second case, because the assessee has filed an updated return, the time limit changes. It is 9 months on the end of the financial year in which the updated return is furnished. So, updated return is furnished in financial year 22-23. So, you have to take 9 months on the end of 22-23. That comes to 31st December 2023. I hope it is clear to all of you. Next question is also based on some important amendment made by Finance Act 2022. There was a search conducted at assessee's premise, and in which there was a cash, undisclosed cash, which was found to the extent of 160 lakhs. Now, the question is, can assessee set off its earlier year brought forward loss and earlier year unabsorbed depreciation against this undisclosed income which was found in search? So, there is a specific section which was made by Finance Act 2022 which says that if an income is found under search and seizure, and if you wish to set off your loss and UAD against that income of undisclosed income under search and seizure, that is not allowed under the income tax law as per section 79A. This is what the law has to say in question number 20. Okay, this is also a Finance Act 2022 amendment. Next question is based on a Supreme Court judgment of SAP Labs India Private Limited. The issue over here is the tribunal has determined the arm's length price. Now the question is, can the assessee or the department challenge to the High Court against that arm's length price? The department or assessee was saying that the issue over here is, because determination of arm's length price is a question of fact, can I go to the High Court to determine the question of fact? The matter went to the Supreme Court because question of fact is not covered in High Court. Only question of law is covered in High Court. The issue over here which went to the Supreme Court is, the Supreme Court said that the High Court can decide the arm's length price under its power. A High Court has the power to determine the arm's length price. Determining the arm's length price does not mean that you are calculating the arm's length price. High Court has the inherent power to check whether the arm's length price is computed as per the provisions of the income tax law 92C and as per the rules of the income tax law, rule 10B, rule 10C, rule 10CA, and so on and so forth. The High Court does not have the power to compute the arm's length price. The High Court does not have the power to compare with the comparable, but High Court definitely has the power to check whether the provisions of the Income Tax Act are properly followed or not while computing what? While computing the arm's length price. This is also the case law which is given in the recent case law of 13 case laws. You can go and check over there also if you want. Okay. The next question, question number 22. Question number 22 talks about a non-resident section. There is a non-resident Mr. Smith who is providing some FTS services to an Indian company, and there is an agreement which is approved by central government, and this non-resident does not have any fixed place of business in India, and therefore section 115A will apply. If this non-resident would have a fixed place of business in India, then section 44DA would have applied. Here 44DA cannot apply because the assessee non-resident does not have a fixed place of business in India. It is providing services directly from outside India. Now we need to answer two things. There are a few more things which are given in the question. The services are utilized in India. Thank you. That is very much required to tax in India. Then the TDS is fully deducted. And one more thing, the assessee only earns this income. Assessee does not earn any other income. Now there is a provision in the law which says that you have to tax such FTS at the rate of 10%, which is given in 115A, or DTAA, whichever is lower. If the tax is deducted at 10% as per 115A, assessee is not required to file ITR. But if the tax is deducted at lower than 10%, that is as per DTAA, then the assessee is required to file return even if the TDS is deducted and even if the assessee only earns this income. So if the assessee want exemption from filing of ROI, the assessee should pay the tax as per 115A rate, not as per DTAA rate. If it is taxed as per DTAA rate, they have to file the ITR. So in the first case, there is no DTAA. If there is no DTAA, assessee will pay tax as per 115A plus surcharge if applicable plus cess. Therefore, there is no need to file ITR. In the second case, the DTAA is there and the rate of DTAA is 8%. Now, because the assessee is charging tax at lower than 115A rate, therefore, assessee will pay tax as per 8%, but the assessee is liable to file the ITR. In third case, the assessee DTAA is showing 15%. Therefore, the assessee will pay tax as per 115A, and therefore, because the assessee is paying tax as per 115A, the assessee will be not liable to file what? ITR under the 115A provision. Okay. The next question is a very simple question. We have done a lot of questions like this. I am not much interested in this DTAA question. First of all, you will take salary 62,000 into 12, then DA 10% of salary into 12, then 50,000 standard deduction, then royalty 98,000, then expenses minus 98,000. That will go under IFOS or PGBP wherever you want to take. Then rental income you will take 2,80,000, 30%. Then dividend from country and 2,20,000, and then you will also take 1% of the stamp duty as your what? 80C deduction. Do you know that when you buy a house property and if you pay the stamp duty, then that stamp duty is also allowed as deduction under 80C. Next is you are 45-year-old and therefore you will get mediclaim premium of how much? Mediclaim premium of 25,000 rupees deduction you will get. Next is your father is 72 years, but unfortunately he is non-resident. Therefore, you will get only 25,000 rupees. Therefore, 50 plus 50, you will get only 50,000 rupees, not 75,000. Then you will compare with the income after from the GTI. You will take 3 lakh rupees 80 QQB, and it's a very, very normal sum. You don't have to pay much attention on this particular question. Next question is a beautiful question. Beautiful means beautiful. There is an Aster Inc. which is in Canada. Listen carefully. And this company has a website in Canada, and which does two things, which does buying and selling for the customers, and it also does advertisement for the customer. It does two things, buying and selling and advertisement. So therefore, the question over here is whether equalization levy will be applicable or not. There are two equalization levy, FA 2016 equalization levy and FA 2020 equalization levy. We need to decide which equalization levy will be applicable in which case. In the first case, in these two cases, the assessee is selling the product through its website. Therefore, 2016 equalization levy will not be applicable. Only 2020 equalization levy we can test over here. In this case also, in first case, the seller is in India, and therefore, if the seller is in India, if the seller has a branch in India, then 2020 equalization levy is not applicable. Go and check the provision. If the seller has a branch in India, then the 2020 equalization levy is not applicable. In the second case, the seller does not have a P in India. Therefore, 2020 equalization levy will be applicable, and you will apply 2% of the value of transaction. How I got 3.6 crore? 2,000 into 12,000 and 1,000 into 150 into 80 rupees per dollar. I will get the total as 3.6 crore. I'll again say why I am not applying 2016 in both the cases, because this is not online advertisement. This is sale through website. Therefore, 2016 equalization levy is not applicable. Why I am not applying 2020 equalization levy in first case? Because the seller is in India. If the seller is in India, 2016 to 2020 equalization levy is not applicable. Why I am applying 2020 equalization levy here? Because the seller is in India. The seller is not in India. Therefore, 2020 equalization levy is applicable, and the buyer is Indian customer, or buyer is buying through an IP address located in India. Therefore, these two transactions will be subject to equalization levy in India. Next case, ABC Limited is an Indian company, and if ABC Limited is making payment of 25 lakhs to Aster Inc., who does not have a P in India, for advertisement, then 2016 equalization levy will apply over here. That is 6% equalization levy at the rate of on 25 lakhs. Okay, now what about the next one? XYZ Inc. XYZ Inc. will not be covered in Finance Act 2016 equalization levy. Why? Because in Finance Act 2016 equalization levy, the payer has to be either resident or either a non-resident who has a P in India. Now, XYZ Inc. is not a resident, neither resident nor a non-resident who has a P in India. XYZ Inc. does not have a P in India, which you can see over here. Therefore, for XYZ Inc., which equalization levy? 2016 equalization levy cannot be made applicable. For them, 2020 equalization levy will be applicable. 2% of 32 lakhs will be applicable over here, and 2% of 32 lakhs will be paid to the government of India. So it's a beautiful question over here. You can go through the solution once at your end if you want. It's a beautiful question. Last but not least, there is a foreign company which has a branch in India. Now, if a foreign company has a branch in India, that is a PE. Now, if they sell some goods through this PE, then that is definitely liable to tax. The question is, what if they directly sell from there, not through Indian PE, but directly sell from there? Then whether that is taxable? That is taxable under UN model, but not taxable under OECD model, because that covers under force of attraction. Force of attraction says what? That once a PE is established in India, then whether you sell through Indian PE or directly from outside India, both will be taxable. But that is only covered in UN model, not covered in OECD model. This is what this question is all about. And this is what your RTP November 2023 is all about. Just go through it and then we'll move ahead with the MTP November 2023 series 1. So let's go ahead now with the MTP November 2001 series 1 discussion. Okay. So we have already done the November 2023 RTP. So now let's go ahead with the MTP series 1 November 2023. Okay. Now the very first question over here is on a total income question. It's a normal question. We are not supposed to follow 115BAA or something like that. It's a normal provision. Okay. Now you need to see first of all the SSC is a manufacturer of fabric since 1st April 2012. The very first adjustment over here is the depreciation which you will add back. Okay. The second one is you are getting some concession from the Maharashtra state government. And if you get any concession from any state government or central government, then that is considered to be an income under section 224(18). If you remember that, any subsidy, grant, reimbursement, waiver, concession, duty drawback, so on and so forth, and by whatever name called, all of them are income under section 224(18). So this is an income, so let it be part of PGBP income. Okay. Next one, you are making some fair estimate with respect to your periodical wage revision every 3 years. So in every 3 years, you make some revision of what your salary for your employees, so wages to your workers. So for that, you are making some estimate, and for that, you are making some provision. So that is something which is allowed as per ICDS also. As per 37(1) also, it is allowed because the estimates are fair. It is not an unascertained estimate. It is not an unascertained liability. It's an ascertained liability. Therefore, you can take the deduction. Next one is you are receiving some dividend from a US company. So reduce from PGBP and show under IFOS. Okay. Next one is there is some destruction of machine on which there is a loss of 17 lakh rupees, and this loss will not be allowed as a PGBP expense because it's a capital loss. Therefore, it is disallowed. You have also received some 3 lakh rupees as scrap. The question has said that ignore the adjustment of scrap. That's the reason we are not talking anything about that scrap. We are just reducing that scrap from our PGBP income. Okay. From the PGBP income, we are reducing it, but we are not giving any effect for that scrap. Whether what will happen with the impact of that scrap, whether it is taxable or not taxable, we are very silent about that. Okay. Next, provision for gratuity is disallowed under 48(7), but whatever gratuity you have actually paid, you will get the deduction of that much gratuity. Next, advertisement in a brochure of a political party is disallowed under PGBP, but because it is paid in check, you can get the deduction under 80 GGB. 80 GGB, you can take the deduction. Okay. Next, long-term capital gains on sale of equity shares on which you have paid STT both at the time of acquisition and sale. Therefore, this will be reduced from PGBP, and under capital gains, it will be chargeable under section 112A because STT is paid both on purchase and sale of equity shares, which is long term. Therefore, you will get an exemption of 1 lakh, and on 2 lakh rupees, you will pay tax at the rate of 10%. Okay. Next, income tax normal depreciation 71 lakhs. You can claim that as a deduction under PGBP. 71 lakhs will be allowed as a deduction. And the next one is you have collected some 8 lakh rupees as GST from customer. Then you paid 8 lakh rupees. So you would have got the deduction of 8 lakh rupees. Then you got refund of 3 lakh rupees from the GST department and you paid only 2 lakh. So out of the refund of 3 lakh, you paid only 2 lakh. Therefore, 1 lakh will be added back. After that, you will compute the tax of the SSC. The tax of the SSC would be 30% because the turnover of last to last year is more than 400 crore rupees. You can check it, please. So let's move on to question number 2 now. 2A, it's a beautiful question. It's a question on cooperative society. A cooperative society is there which is engaged in marketing of agricultural produce grown by its members. So such kind of cooperative societies are eligible for deduction under ATP. ATP, they are eligible. Okay. Now, the profits and gains from such activities 65 lakhs. This will be subject to deduction under ATP. Apart from that, this cooperative society will also be eligible for ATJJAA because they are employing 10 new employees with an emoluments of up to 25,000 rupees. Because if it is more than 25,000, you will not get the deduction of ATJJAA. And it is employed for more than 240 days. You can check it over here. And the SSC is also liable for what? Audit. And the SSC is also paying the salary, that is the emolument in account paycheck. All the conditions of ATJJAA are fulfilled. Therefore, the SSC is also eligible for ATJJAA. Apart from that, the SSC is also earning some interest on FD of 30 lakh rupees. So now we are supposed to compute the total income tax liability as per the for AY 23-24, and we are supposed to advise the SSC whether the SSC should opt for an alternative tax regime under 115 BAD or whether it should stick to the normal provisions of the income tax law. Now, option 1, if it sticks to the normal provision. Now, in option 1, it has to make two calculations. One as per the regular provision and one as per the AMT 115JC. Because if the SSC opt for the normal provision, then AMT is applicable. But if the SSC opt for 115 BAD, then AMT is not applicable. So, let me do the calculations for all of you. In normal provision, how will you compute the tax? And how will you compute the income? The income will be 65 lakhs plus 30 lakhs will be your GTI. Then in normal provision, SSC will get two deductions. first assessee will get 80P of 65 lakh deduction, and second assessee will get 80 JJAA. 80 JJAA how much? 80 JJAA will be whatever is the amount, that is 10 employees into 11 months into 22,000 into 30%. Okay. And then whatever the income comes on that, assessee will apply the slab rates up to 10,000 10%, about 10,000 20%, and about 20,000 30% surcharge and cess if applicable. Then if the assessee, then the assessee has to make AMT calculation. While calculating AMT, assessee has to compute the adjusted total income. Adjusted total income, while computing the adjusted total income, be very careful. Adjusted total income will be total income plus what? Only 80 JJAA. You will not add ATP. Why not add ATP? Because ATP is not subject to AMT. Therefore, you will only add 80 JJAA, add 80 JJAA, and then apply the tax rate of AMT. The AMT tax rate for cooperative society is 15% plus surcharge and cess. Surcharge if applicable and cess always. Once this calculation is done, this will be your first tax. Then you go for 115 BAD. In 115 BAD, what is the total income? How will you compute the total income? In 115 BAD, you will not get the deduction of ATP, but you will get the deduction of 80 JJAA, just opposite of AMT. In 115 BAD, you will not get the deduction of ATP, but you will get the deduction of 80 JJAA. Do that, compute the tax. Tax will be 22% plus 10% surcharge always in 115 BAD and 4% cess. Okay. Your surcharge, left hand side, option 1 surcharge depends upon total income. Right hand side surcharge is always applicable at the rate of 10%. And then see which is tax is higher. Left hand side tax is higher or right hand side tax is higher. Whichever is higher, ignore. Whichever is lower, you can offer that particular option. Okay. Next one is also a very beautiful question. There is a German resident, German citizen who is a non-resident in India and is working in a German company. Now that German company has a P in India. This is a very important sentence. That German company has a P in India, it means that German company has a business or trade in India. And therefore, this employee is coming to India for 85 days in the current year and the company is paying him 28,000 which is borne by the Indian P. Now, whether this salary of 28,000 will be taxable in India or not, the answer is yes, this 28,000 will be taxable in India. Why, sir? There was some exemption under section 1066. Yes, exemption was there under section 1066, but that was subject to following condition. There is a foreign citizen who is coming to India as an employee of a foreign company and is coming to India for up to 90 days, and that foreign company should not have any trade or business in India, and that foreign company should not claim that expenditure as a deduction in India. Now that foreign company has a trade and business in India because it has a P in India. Because it has a trade or business in India, the employee will lose the exemption. At the same time, the foreign company is also claiming that deduction in India because the P of India is bearing that expense. Therefore, if the foreign company is claiming that deduction in India, then also the exemption in the hands of the employee will be lost. Okay. Next issue. There are 3 points in this particular question. Very good question. This Charles, which is a non-resident, he is purchasing shares of Indian company in foreign currency. So if the non-resident is purchasing the shares of foreign company, shares of Indian company in foreign currency, then the provisions of first proviso to 48 shall apply, and you have to convert your sale consideration, expense on transfer, cost of acquisition as per the average of TTBR, TTSR. So sale consideration will be converted as per average of TTBR and TTSR on the date of sale, and cost of acquisition will be converted as per the average of TTBR and TTSR on the date of purchase. And once you do that, you will reconvert the gain into rupees as per only TTBR on the date of transfer. Now you will not take average. While converting into INR, you will only take TTBR on the date of transfer. Is it clear? I hope it is clear to all of you. And the third case is similar to a Vodafone case law. Mr. Charles, a non-resident, is selling some shares of a foreign company. Now that foreign company, if you want to take tax from Mr. Charles for sale of shares of a foreign company, then the shares of foreign company should derive its value substantially from asset located in India. Then only it will be deemed to accrue rise in India. Now, the income of AG, that is Aribits GmbH, is not deemed to accrue as India because the shares of Aribits GmbH does not derive its value substantially from asset located in India. Why are you saying so, sir? Because to fulfill that condition, the assets in India should be more than 10 crore rupees. And here the assets in India are only 8 crore rupees. Therefore, this income will not be taxable in India. Last but not least, this assessee is also earning some dividend from India, which is received in India. Therefore, it is taxable. Because the dividends are received in India, that will be subject to what? That will be subject to taxable. Question number 3A. Subpart 1, 2, 3. Now there is a university which is registered under section 1023C. Now it is partly for educational purpose and partly for hospital purpose. And for both the purpose, they are receiving revenues of 3 crore plus 3 crores. Are they liable for registration? The answer is yes. If the aggregate receipt is greater than 5 crore rupees, they are liable for registration. They are liable for approval. You are not supposed to see individual receipts. If the aggregate from hospital and from education is greater than 5 crore, they are liable for what? Registration. Next one. There is a registered charitable trust who has incurred some losses in earlier years because there was excess application. Because of excess application, there is a loss. Can the assessee set off that loss in the current year? That is not allowed. That is absolutely not allowed. That is prohibited under the income tax law. Next, this trust has borrowed 40 lakh rupees and out of the borrowed fund, they are incurring some expenditure for the purpose of building some, making some building for the school purpose. So if you take a loan and incur an expenditure out of that loan, then that is not considered as an application. For that purpose, if you want the application as deduction, you have to repay the loan. So whatever amount is repaid, that is 5 lakh rupees is repaid, that will be considered as what? That will be considered as application for the purpose of income tax law. Okay. Next, is the advance ruling authority for advance ruling has the power of compelling the production of books of accounts? The answer is yes. The authority for advance ruling has all the powers under section 131, which are the powers of income tax authority to issue summons. That same power is there with the authority for advance ruling also. Honestly speaking, it should not be authority for advance ruling now. It should be board for advance ruling now, honestly speaking. So board for advance ruling has all, because now the authority for advance ruling is gone. Board for advance ruling has come. So board for advance ruling has all the powers of income tax authority, which was given under section 131 for issuing summon. And in 31, there is one of the power which speaks about what? Production of books of accounts, compelling and production of books of account. There were three more powers: issuing commission, production, compelling and production books of account, then inspection and discovery, and then enforcing attendance of any person. These four powers were there under income tax authority for under section 131. All the powers will be exercised here also. Next question is on equalization levy. Pay attention, please. There is a foreign company, there is a non-resident who does not have a P in India. There is another non-resident who does not have a P in India. And this PQR Inc. is giving some online advertisement services to MNO Inc. non-resident who does not have a P in India. Now there are two equalization levy. One is 2016 equalization levy 6%. One is 2020 equalization levy 2%. Now 2016 equalization levy is not applicable here. Why? Because for 2016 equalization levy to apply, the Indian entity has to be resident who is doing business, or a non-resident who should have a P in India. Now this MNO is neither resident who is doing business, nor it is a non-resident who has a P in India. Therefore 2016 equalization levy will not apply because the MNO does not have a P in India. For 2016 equalization levy to apply, MNO should have a P in India. Therefore in this case, the MNO will not be covered under what? 2016 equalization levy. Yes, but PQR is giving services, online advertisement services to MNO, and the receipts are also greater than 2 crore rupees, and these services are utilized to target what? To target Indian customers. It is very clearly written in the question that they want to increase the share in the Indian market. It means they are targeting Indian customers. So this can be covered in 2020 equalization levy, and this will be subject to 2% equalization levy on 5 lakh rupees. 2% equalization levy on 5 lakh rupees will be charged in this particular case. Next question is based on some TDS provisions. Pay attention, please. There is an Indian company who is paying some salary of 7,30,000 to the employees and non-monetary perquisites of 1,20,000 to the employee. Therefore, the total income is 8,50,000. 50,000 will be the standard deduction, and on 8 lakh, the company will compute tax as per the normal provision. Do not follow 115 BSE. And whatever is the tax which is coming, that tax divided by 8 lakhs will give you the average tax rate in India, and that much will be the TDS which will be deducted by the Indian company over here under section 192. Okay, next one, an infrastructure debt fund which is covered under section 147 is paying some interest to a non-resident, that is to a foreign company. Therefore, if an infrastructure debt fund is paying some interest to a foreign company, the TDS will be deducted under 194 LB at the rate of 5% plus surcharge and cess if applicable. Okay, so because it is covered in 194 LB, you have to deduct TDS at the rate of 5%. But at the same time, if the other person is located in NJA, is located where? In notified jurisdictional area mentioned under section 94A, then the TDS will be deducted by the payer at the rate of 30% plus surcharge and cess if applicable under section 94A. Be very careful about it. Okay. Next one. There is a contractor and there is a contractee. And the contractee is giving some contract to the contractor, and the material is supplied by the contractee only. So if the material is supplied by the contractee, then the contractor is doing work contract, and the contractee has to deduct what? TDS. Now the question is on how much amount. If breakup of service and goods is separately given, then deduct TDS on service component. But if the breakup of goods and services are not given, then the TDS will be deducted on the entire amount. Be very careful. Last but not least, over here you are paying some paying some money to a former Indian cricketer for doing commentary. So if you are making some payment to an Indian commentator for doing commentary, that will be subject to TDS under 194J because they are considered to be covered as a sports person. Sports activity is covered over here, and 194J covers sports activity. It covers cricketers, sportsmen, sports person, umpires, referee. Everybody is covered under 194J if the other person is what? Is a resident. Next is a very simple question actually on transfer pricing. Anush Limited is an Indian company. It is declaring an income of 300 lakhs and it is entering into 3 transactions. First of all, there is one foreign company, Rida Limited, who is a non-resident, and there is Anush Limited, who is resident. So one is resident, one is non-resident, and one holds 30% shares in another. Therefore, both of them are associate enterprise. This transaction is subject to transfer pricing. Therefore, 10,000 cars are sold for $200 lesser. Therefore, you have to add back $200 into 10,000 cars into conversion of dollar into rupees at the rate of 63, which is given over here. You can see. So you have to convert your dollar into rupees. Okay. So this much will be added back to the income of Anush Limited. Next, Anush is also paying some royalty to Kyoto, and Anush is using the technical know-how of Kyoto. Now we are assuming that Anush is using 100% technical know-how of Kyoto. Otherwise, it cannot be considered to be a deemed associate enterprise. Because if you want to make an entity deemed associate enterprise, the entity, one enterprise should be wholly dependent on the other enterprise for know-how, patent, copyright, trademark, license, franchise, any other business or commercial right. Therefore, if it is wholly dependent, then only it is associate enterprise. Otherwise, it is not. So we are assuming that it is wholly dependent. Therefore, you are paying $30 lakh extra. Therefore, $30 lakh extra into 63, you have to add it back to the income statement. Okay, as a adjustment to arm's length price. Next, Anush is also taking some loan from a German company. It has taken 1,000 euros loan. 1,000 euro into 84 will come to 84,000 crores. Whereas the assets of Anush are how much? It is 90,000 crore. So 90,000 crore is the asset and the loan is 84,000 crore. Therefore, the one entity is financing another entity more than 51% of the total book value of the asset. Therefore, both of them are deemed associate enterprise. And therefore, it is subject to transfer pricing. I am paying how much interest to the other company, German company? 10%. I should have paid how much? I should have paid only 9%. Therefore, 1% I have to add it back. So, 1,000 crore is the loan amount. Into 1% I have to add it back. Into 84 rupees will be the conversion of euros into rupees. That much I have to add it back to the income statement. Okay. So, this is what this question is all about. Next question is a theoretical question. There was a Commissioner of Income Tax. See the sequence of event. Who issued a notice to revise order under section 143, and therefore the revisionary proceedings under 263 was initiated. Now, after issuing the first notice, the CIT is issuing second notice based on some survey which was conducted by the Income Tax Authority. Now, the second notice content is different from the first notice content. Listen carefully. First notice is issued by the CIT to initiate 263 proceedings to revise the order under section 143, and the proceeding was initiated under 263. Now, some survey was conducted on assessee. Based on that survey, the CIT is now issuing second notice, and the content of the second notice is different from the content of the first notice. Can the CIT revise the order based on the second notice? And the answer is no. The court has said that you cannot change the content in the notice. You have to revise the assessment order based on the first notice only. You cannot revise the assessment order based on the second notice. Okay. Next one. The Director General of Income Tax has in possession some unaccounted cash. Now, with the help of that cash, the Director General is issuing summon under section 131 for seizure. Can you issue summon under 131 and seize the cash? No, no, no. For seizure, 131 is of no use. For seizure, you have to issue what? You have to issue the search warrant under section 132. Only a search warrant can lead to what? Seizure of cash. Only issuing a summon cannot seize your cash. Check it, please. Now, next one is a very simple DTAA question. Mrs. Rajni is there, 63-year-old senior citizen and settled in Ranchi. She is earning some income from country M in India. The first income which she is earning from country M is $10,120 from a concert, and you have to convert that as per 69 rupees. Okay. Then she is earning some rental income of $25,000. On that, you have to deduct $200 of municipal tax, and on that 30% standard deduction. Then she is earning some 15 lakh rupees from performance held in India, and then earning of interest about 4.2 lakhs. 15,000 from saving bank account also in the form of an interest. Okay. Now, apart from that, she is paying some insurance claim for herself and her husband. Therefore, she will get 50,000 deduction as she is senior citizen and she is resident. Resident senior citizen gets 50,000 rupees deduction under 80D. Apart from that, she will also get 1.5 lakhs as deduction under 80C for PPF. Apart from that, she will also get 80 TTB because she is senior citizen and resident. 80 TTB, 50,000 deduction from FD and saving bank both. FD interest is also deductible there, and saving bank interest is also deductible, and even RD interest is deductible under 80 TTB. Apart from that, she will not get the deduction of this 5-year FD for 4 lakh rupees because it is in her son's name. After that, you have to compute the tax, and then you compute the average rate in India, and then find out the doubly taxed income. Apply 20% or average rate in India, whichever is lower, as a relief. Okay, it's a very, very simple question. Now, the next question is based on the last question over here in MTP 1 November 2023. The last question over here is based on NBFC. The NBFC is receiving some deposits from its customers, and therefore we have to check whether we have to apply 269SS, and on repaying of deposit whether we have to apply 269T or not. First of all, 269SS and 269T is applicable for NBFCs. It is not applicable for banking industries, but for NBFCs it is applicable. Be very careful. First of all, you are receiving 15,000 rupees in bearer check. So that is allowed because it is not crossing the limit of 20,000 rupees. You should not receive 20,000 or more in the form of deposit from by other than account pay check, account pay draft, ECS, and such as the electronic mode. So first 15,000 269 SS is not attracted. Now the second transaction of 15,000 rupees, which is in cash, which you have received from the customer, now you cannot receive in cash, because if there is already an outstanding of 15,000 rupees and you are receiving another 15,000 rupees in cash, so you have to aggregate both of them and check whether 20,000 is crossing or not. There is already an outstanding of 15,000 and you are receiving another cash of 15,000. Taking together both of them, if it is 20,000 or more, 269 SS is attracted, and therefore on second transaction 269 SS will be attracted. Penalty will be imposed under section 271D by the Joint Commissioner of Income Tax. Okay. Now, at the time of repaying the things, how the things will be worked. Now, there is a total of around 31,000 of certificate which is issued by the company, and out of which the company is repaying 16,500 by bearer check. Okay. 16,500 and 15,500 is the total amount of certificate. Now, because there is already an outstanding of 20,000 or more, you cannot give a single penny in other than account pay check, account pay draft, ECS, and such as the electronic mode, because you already have an outstanding of 20,000 or more. Now you cannot repay even a single rupee in cash or bearer check or a normal check. You have to pay by account pay check, account pay draft, ECS, such as the electronic mode. You have to pay by the 4 modes. Therefore, the first 16,500 is a violation of 269T, and therefore the Joint Commissioner will impose penalty under 271E. Now, the next 15,500 is the only outstanding amount. Now, because the 15,500 is the only outstanding amount, that outstanding amount is not exceeding 20,000, and therefore this 15,500 will not be subject to what? The provisions of 269T. So this is what this MTP is all about. The next 2 questions are very theoretical in nature. You can go through them at your end, and we will move on to the next MTP after this. Okay. So let's go ahead with the next one, that is MTP series 2 November 2023. Okay, let's go at the first question, which is a traditional question of total income. There is an Indian company which is a manufacturing company, but you need to understand that this question is based on the provisions of 115BAA. Okay, so you have to follow the concessional tax rate. Therefore, this turnover is of no use. This turnover is useful in what? In your normal provision, not in alternative tax regime under 115BAA. Okay. Now, accordingly, you need to answer all the questions. The very first adjustment is depreciation, which you will add back. Okay. Next one, you have given some donation to political party, that is not allowed in 115BAA. Donation to political party not allowed in 115BAA. Next one, scientific research association, you are giving some donation. Section 35 subsection 1 clause 2 not allowed in 115BAA, therefore add back. Next one, you are receiving some dividend from a foreign company, but at the same time, first of all, we'll give the effect of this. Remove from PGBP and show under IFOS, and at the same time, you are also distributing dividend to your shareholder of how much? Of 12 lakh rupees on 31st of May, which is 1 month prior to the due date of filing of return. Okay. Therefore, ATM is allowed under 115BAA. Do you remember ATM? You receive dividend, you pay dividend, then whatever dividend you paid compared with whatever you receive, whichever is lower, is allowed as deduction, provided you pay dividend within 1 month prior to the due date of filing of return, which we are doing so. Okay. Therefore, you will get deduction under ATM, and ATM is allowed in 115BAA. In 115BAA, 3 deductions are allowed. One is ATM, one is ATJJAA, and one is ATLA. These 3 are allowed in 115BAA. Next one is long-term capital gains on sale of equity shares on which STT is paid at the time of acquisition and sale. Therefore, this is covered in 112A. So you will reduce from PGBP 4 lakh rupees and show under what? Capital gains 4 lakh rupees. It will be taxable at 10% on 3 lakh rupees. 1 lakh you will get as an exemption. Okay. Next one. You have taken a loan of 4 crore 20 lakh rupees. How much? 4 crore 20 lakh rupees you have taken a loan on 1st of June. So on that, interest will come as 10 months interest will be 35 lakhs. But you have taken this loan for the purpose of purchasing a plant and machinery which is put to use from 1st of June. So from on 1st of Jan. So from 1st of June till 31st of December, that is 7 months. You have to capitalize the interest. So 7 month interest I will capitalize. What about the remaining 3 months, Jan, Feb and March? That will be disallowed. Why? Because that is not paid before the due date of filing of return. Check please. If it would have been paid before the due date of filing of return, I would have taken that as a deduction. Okay. So I will add this 24.5 lakhs to the cost of asset, and this remaining 10.5 lakhs will be disallowed under the head PGBP as per section 43B. Now, apart from this, you need to remember that one more thing you have to add, that is 1 lakh rupees you have to also add as a technician, foreign technician salary, 1 crore rupees, whatever it is, you have to add that also, and then you will claim depreciation at the rate of 7.5%, because it is put to use for less than 180 days, and you will not get the deduction of additional depreciation. Additional depreciation is not allowed in 115BAA. Next is a routine adjustment, profit on sale of land to a wholly owned subsidiary. So if you sell asset to your wholly owned subsidiary, capital gains is exempt provided the recipient, the receiver is an Indian company. Okay, so this is exempt, reduced from PGBP, and then show that as an exemption under the head capital gains. Okay, next one is a very intelligent point. First of all, you sold some goods of 22 lakh rupees, out of which 12 lakh rupees was written off, so you claim that as a reduction. Then how much is receivable now? Now the receivable amount is 10 lakh, but you receive 1 lakh rupees extra, that is you receive 11 lakh rupees. Therefore, whatever extra you receive, that will be taxable. But unfortunately, you have credited entire 11 lakh rupees to the P&L account. Now, because you have credited entire 11 lakh rupees to the P&L account, only 1 lakh rupees is extra, that is taxable. Therefore, you will reduce what? Reduce 10 lakh rupees from your P&L account. Okay. Next is your depreciation, which is your depreciation as per the income tax rules. You will reduce this depreciation. Then office building purchased on 15th of December, put to use on 15th of December, you will get 50% depreciation on that. 3 crore into 10% into 50%, that is 5% of 3 crore. Then computer, which is purchased and put to use on 11th of May, so you will get full 40% depreciation on that. And that's it. This is what this question is all about. Then you will compute the tax liability, and the tax liability is 22% tax, 10% surcharge, and 4% cess. Okay, check it please. Now let's move on to the next question, and the next question is on partnership form. Always remember that whenever you compute a partnership form question, always compute first of all the book profit as per 40B, because that will be needed to compute the remuneration which is liable to the partnership form. Okay. Therefore, in this question, you are supposed to compute the total income as per the normal provision. You are not supposed to follow AMT and all, 115JC and all. Don't do all those things. Only compute total income, that too as per normal provision. No need to compute the tax liability also. Okay. Now, the very first thing over here is you need to compute book profit. What is book profit? Book profit is nothing but your PGBP income only, and at the end you have to add back what? Your remuneration if debited to P&L. If it is not debited, then ignore that step. Okay. The very first thing is interest on capital 13%, therefore 1% will be disallowed. Okay. Next, the firm has taken loan from one of the partner at 15%, therefore 3% will be disallowed. Only 12% is allowed. If a firm takes a loan from partner, 12% will be allowed as deduction to the firm and not 15%. Okay. Next is income from fixed deposit. Interest you are earning from fixed deposit, reduced from here. It is not a part of PGBP income, show under IFOS. Okay, income from other source. Next, depreciation as per the books of accounts, you have to add it back because that is not allowed under PGBP. Next, you have purchased some building in 2019. That's a depreciable asset. The WDV of that building today is 36.45 lakhs. Now you are selling that building in 2022-23 for 90 lakhs. Therefore, the differential amount of approximately 53 lakh rupees will be considered to be what? Will be considered to be a short-term capital gains. Now, this short-term capital gains you have credited to P&L. Therefore, the first step which you are supposed to do is to reduce this from P&L. Okay, because this is not a P&L income, this is a capital gains income. Reduce this from P&L, show under capital gains. Now, in capital gains, when are you transferring? 10th of October 2022. Now, within 6 months from this date, check over here, you are purchasing NHAI bonds of 60 lakh rupees. Can you get exemption under 54EC? The answer is yes. That if you sell a building which is long term, if you sell a building which is long term, if you sell a land which is long term, then you can claim exemption under 54EC if you invest within 6 months on the date of transfer. Now, when the bonds are issued, that is not relevant. When the bonds are purchased, that is relevant. When you have invested, that is relevant. You should invest within 6 months. The bonds can be issued beyond 6 months also. That is not relevant. Okay. And therefore, here you will get 50 lakh exemption over here. But sir, that gain is short term, na? Gain is not relevant. What is relevant is the nature of asset and not the nature of gain. It was held by Supreme Court in the case of Ace Builders Limited that what is relevant to claim exemption under 54EC is the nature of capital asset should be long term and not the nature of gain. The block asset is capital asset. If the block of asset is long term, the gain is short term, it doesn't matter, you can claim exemption under 54EC. So it's a very intelligent point. Please be careful with this point. Okay. Next one, there are four partners, out of which 2 are working partners, and both the working partners you are giving 20,000 salary. Therefore, to both the partners you are giving 40,000 salary per month. In all, you are giving 4.8 lakhs as a salary in the entire year. This is the actual remuneration given to the working partner. This will be useful to compare with your maximum limit. It will be compared with maximum limit, and whichever is lower will be allowed as deduction to you under the head PGBP under section 40B. Okay. Next is I am coming to this adjustment number D now. Depreciation as per the income tax rules that you can reduce. Next, you have purchased some motor car which was purchased on 1st of Jan 2020. Very important date. Do you remember that? If you purchase a motor car and put to use between 23rd of August 2019 to 31st of March 2020, then you get extra 15% depreciation. So this is that case. So in this case, therefore you are going to get 30% depreciation instead of 15%. Okay. Next one, mobile phones will be subject to 15% depreciation, but because it is used for less than 180 days, you will get 7.5% depreciation. Okay. After doing all these adjustments, you are going to compute your book profit. After that, you will see what is your book profit. If the book profit is up to 3 lakh, then 90% of book profit, 1,50,000, whichever is higher. If it is above 3 lakh, then on the balance income, 60% of book profit. Whatever is the amount, that will be the maximum limit. Compare that with 4.8 lakhs. Whichever is lower will be allowed as what? Deduction under 40B. Last but not least, this assessee is also what? Is also taken approval what? Has also taken approval on 30th of March 2020. A letter of approval is taken on 30th of March 2020 for starting a unit in SEZ. Do you remember that before COVID, till 31st of March 2020, if you have taken a letter of approval, then you can start your unit up to 31st March 2021 also. That's what the assessee is doing. The assessee is starting the unit on 31st of March 2021, and therefore the assessee would be eligible for 10AA deduction. 10AA deduction will be how? Profit into export turnover of 40 lakhs and total turnover of 120 lakhs. Assessee would be eligible for deduction of 100% for the first 5 years, and therefore that will complete this particular question. So it's a very beautiful question. Okay, next question is a very simple question on DTAA. There is an assessee, Mr. Pradeep, whose age is 48 years, resident. He is earning some income from India, country G and country M. From India, he is earning some business income from Indore, that he will add in the income statement. From business, from partnership firm in Bhopal, he is earning some share of profit, that will be exempt under section 10(2)(a). Then from country G, he is earning some agriculture income, that will be taxable under IFOS, because country G agriculture income is not exempt, Indian agriculture income is exempt. Then there is some brought forward loss from country G that he can set off against the business income in India. That loss might not be allowed in country G, but that can be set off against Indian income. There is no harm in that, you can do that. Okay, next, then dividend income from country M, 10% tax you have paid. You have to convert this $30,000 into whatever is the conversion rate which is given, 70 rupees. Then rental income 52,000. Then on that 6,000 rupees you have paid as municipal tax, you can take that as a deduction. And on balance income, you can claim 30% standard deduction. Then ATC you will get, ATC PPF deduction you will get, and also ATD you will get only 25,000 because you are not a senior citizen. You are a resident, but you are not senior citizen. Therefore, you cannot get what? You cannot get full amount of full 28,000. Only 25,000 will be allowed as deduction. Then the normal routine thing, you have to follow the old regime and not the new regime. 115 BSE should not be followed. The old regime should be followed. Apply the tax rate, find out the average rate, compare with the foreign company's rate, and then whichever is lower will be applied on the doubly taxed income, and then you will claim the relief under section what? Under 91. Next one is an accredited income question. Question on accredited income 115 TD. Pay attention please. One important point to be kept in mind in this question is this trust got registered in 2012 and they purchased a land in 2009. Believe me, keep this point in mind. They have asked this point many times in the examination, that if the trust is registered and if you have purchased some asset before the registration of the trust, then that cannot come in accredited income. Therefore, this land cannot come in accredited income because this was purchased before the trust was registered under the income tax law. Next, whether this land will come? Yes, this is purchased after the trust is registered. Therefore, this land will come, and you have to take the stamp duty value of this land, which is given below 1050. For equity shares which are listed in a stock market, you have to take average, and average is 1099 plus 1052, 51 divided by 2, 1075 will be your average rate that you will take as what? As your value for what? Equity shares. Then for nationalized banks, you will take this bank amount which is mentioned in the bank. For scheduled bank, you will take the amount which is mentioned in the bank. For cash in hand, you will take the amount which is mentioned in the cash in hand. Okay. Then creditor, you will not take full creditor. Why? There is some hidden point over here. Out of 335 lakhs, 30 lakhs creditor is there for which there is no bill receivable, there is no bill available. Therefore, it is not crystallized liability. It is not sure liability. I am not 100% sure about this liability. Therefore, this 30 lakhs cannot be taken in creditor. You will take only 305 lakhs in creditor. After that, you will apply what? The accredited income tax, which is 34.944% tax. And after that, you will pay that tax within 14 days. From what? Within 14 days from 31st Jan 2023, on the date on which the registration was cancelled. Check it, please. Now, let's move on to the next question. The next question is based on section 44C. There is a foreign company who has a branch in India, and that foreign company is allocating some head office expenses to India. So, how much head office expenses will be allowed in India? It is allowed as per section 44C. It is actual amount allocated to Indian branch or 5% of adjusted total income, whichever is lower will be allowed. Okay. Now, how to compute the adjusted total income? Adjusted total income is nothing but your total income plus depreciation. No, do not add depreciation. Plus UAD. Yes, add UAD. Plus family planning capital expenditure. Yes, family planning capital expenditure will also be added. Plus scientific research expenditure. No, do not add scientific research expenditure. Plus brought forward loss. Yes, add brought forward loss. Plus chapter 6A. Yes, add chapter 6A. Plus head office expenses which are allocated to branch. Yes, you have to add back. You will not add back. Be very careful. The current year depreciation. You will not add back the scientific research. It is not mentioned in 44C. You will add back the remaining item. You will get whatever amount. Take 5% of that. Compare with 120 lakhs. Whichever is lower will be allowed as what? Will be allowed as deduction to you. Okay. I hope it is clear to you. Next, question is based on TDS. There is a person, Mr. Swaraj, who is remitting some 7,80,000 outside India through an authorized dealer for the maintenance expenses of his son who is studying outside India. Suppose my son is studying outside India and I am sending some 7,80,000 rupees for him for his maintenance expenses. Okay. So therefore, 7 lakh exemption, 5% TCS in excess of 7 lakh rupees. Okay. Now, next, he is also remitting 5,80,000 through the same dealer for his son out of the education loan taken from his employer. So I am taking loan from employer and then I am sending outside India for my education purpose of my son. Now, if I would have taken loan from a financial institution not from my employer. If I would have taken a loan from a financial institution in India and I would have sent that money, then I would have get separate 7 lakh exemption also. Then I would have get 0.5% tax benefit also. Here I am not going to get separate 7 lakh exemption, nor I am going to get 0.5% separate tax benefit. Okay. Here both the amounts will be clubbed and you will get only one time 7 lakh exemption, and that too you will be liable to pay what? 5% TCS on that particular amount. Okay. This is what this question is all about. Next question. There is a e-commerce operator who is selling some goods through there is an e-commerce operator who is selling some goods through its seller on its website. Okay. Now, unfortunately, the seller is not giving any PAN or Aadhaar. Generally, if the other person, that is the payee, does not give a PAN or Aadhaar, then you are supposed to deduct TDS at the rate of 20%. But in this case, remember, in 194O and in 194Q, if the payee does not give a PAN, then you will not deduct at 20%, but you will deduct only at 5%. Check it, please. Now, the next question is a beautiful question. There is one husband, Mr. Pradeep, who has gifted 30 lakh rupees to his wife. Now, on her 30th birthday. Now, what wife has done? Wife has bought a car of 29,52,000 rupees, which is the final price. But out of this 29,52,000 rupees, 2,15,000 is RTO, 51,000 is insurance, extended warranty 25,000, accessory charges 35,000. Now, if I remove all these things, I will get 26,24,000 as ex-showroom price. This is the price on which TCS is collected by the dealer. So now, wife, when she went to buy this particular car, 1% TCS on 26 lakh would have been collected by the dealer. Okay, keep this point in mind. Apart from this, wife does not have any other income. She only has an income of 25,000 rupees rental income, which will come to 3 lakh rupees. 90,000 will be the standard deduction which she will get, and 2,10,000 will be the total income of wife. So wife's total income in the current year is only 2,10,000. The question is she liable to file the return? As per this amount, she is not liable to file the return. But there is one notification which has come under section 139, if you remember, that if there is a TDS or TCS of 20,000, 25,000 or more deducted in your name, if there is a TDS or TCS of 25,000 or more deducted or collected in your name, you are liable to file the income tax return. So in this case, wife is purchasing a car of 26 lakhs for 24,710 rupees. Therefore, there is a TCS of 26,000 collected in her name. Therefore, there is a liability to what? File return by the wife. Okay. This is what this question wants to tell you. Now, the next question is based on a very practical concept, not there in your study material also. This concept is not there in the study material, but they have asked this particular question in the MTP. So they might repeat in the exam also. Be very careful. There is one company, Red Limited, which is an Indian company. There is one company, Timex INC, which is in country X. And India, this company holds 27% in Indian company. Therefore, Indian company will pay what? Will pay dividends to what? Timex. Now, India has entered into a DTAA with country X, and India says that we will charge such dividends at 15%. Now, pay attention on the date on which it is entered. This DTAA is entered on 1st of Jan 2018. Now, this is the date on DTAA is entered between India and country X, and it is said that the dividend earned by the country X people will be subject to 15% tax. Now, after 5 months after that, India entered into a DTAA with country Y also on 15th of May 2018. On that date, country Y was a member of OECD and country X was also a member of OECD since 2015. Okay. Now, country Y, in case of country Y, we are giving a relaxation of 10%. Okay. Now, 5 months back when we entered a DTAA with country X, at that time we are charging 15%. 5 months later when we are entering into a DTAA with country Y, we are charging how much? 10% DTAA tax on dividend. So, country X people are getting angry on us. Therefore, the government said that we will bring a notification, don't worry. We will apply 10% to country X people also. But the condition is, on the date on which we are entering into a DTAA with country Y, on that date, country Y should already be a member of OECD. If country Y was not a member of OECD on the date on which we are entering into a DTAA with country Y, we will not extend this benefit to country X. Therefore, the question is, on the date, when are we entering into DTAA with country Y? 15th of May 2018. On that date, is country Y already a member of OECD? Yes. Therefore, you need to extend the benefit to country X also. Suppose if country Y became the member of OECD in 2020, then this benefit will not be extended to whom? To the country X people. Check it, please. Now, the next question is on dispute resolution committee. There is a person, Mr. Sharma, whose total income declared in the return of income is 28 lakhs, which is less than equal to 50 lakhs. Okay. and the AO has increased the assessment by 5 lakhs, which is less than equal to 10 lakhs. So remember, if your total income as per the return is up to 50 lakhs and the AO does not increases your income beyond 10 lakhs, then you are eligible to file what? File an application to DRC. Plus, there should not be any detention order against you. So there is no detention order against you. There should not be any prosecution against you. If there is a penalty which is imposed, that is fine. There should not be any penalty against you. There is no condition like that. There should not be any prosecution. There should not be any detention order. There should not be any penalty against you. There is no condition like that to go to DRC. Okay. So this person, Mr. Sharma, can go to DRC. Second, by when he should go to DRC? The time limit is within 1 month from the date of order. So whenever the order was passed, within 1 month from that date, you have to go. Okay. So you have to go till 25th of December 2023. Okay. Next, if the order is passed against you, can you file an appeal? Appeal is not possible against DRC order. DRC order is not appealable under the income tax law. Last but not least, if the assessment order which is passed over here is obtained, is based on the information received under a DTAA with country X. So if India has a DTAA with country X and AO has received some information under section 90 and 90A under DTAA, and based on that the AO has passed an order, then it is not possible to go to what? DRC. Then you cannot go to DRC. Okay. The next question, question number B, talks about, are the following assessees liable to file the return? Now, it's a very simple question. Mr. Arvind is there, whose business turnover is 70 lakhs, which is more than 60 lakhs. Any person's business turnover is more than 60 lakhs, he is liable to file the income tax return. Don't see the total income. Then total income is not relevant. There is a separate notification for that. Go and check in section 139. Okay. Next, if any person deposits in a saving bank 50 lakhs or more, 50 lakhs or more, that person is liable to file the income tax return. Go and see the notification which is given under section 139(1). 50 lakhs or more, if you deposit in a saving bank account, you are liable to file income tax return. Okay. Next question. Mr. Shalin is there, who is a resident of India. He is agreed by the order of advance ruling. His question is, can he file an appeal against the advance ruling order? Yes, you can file an appeal against the advance ruling order to High Court within 60 days. So within 60 days, you will get some extension also if there are genuine reasons. But by default, the time limit is within 60 days on the date of receipt of order. You can file an application to what? Higher authority. Okay, that is High Court. Next, there is another question which is over here. There is a public sector company who is planning to go to advance ruling. But they have one concern. The concern is their matter is already pending before the ITAT. Can they go to what? Advance ruling authority? Yes, they can go to advance ruling authority. For PSU, there is a special exemption that if the PSU's case is pending in front of income tax authority or ITAT, they can go to what? Advance ruling. But if their case is pending in front of High Court or Supreme Court, they cannot go. In this case, it is pending in front of ITAT, therefore they can go for what? Advance ruling. There is no harm in that. Next one is based on equalization levy. There is a Singapore-based website which is a non-resident who does not have a P in India, non-resident who does not have a P in India, and they are selling goods to India, person resident in India, or by using IP address located in India. And the total amount of sale is exceeding 2 crore rupees. So if a non-resident who is owning a website and that non-resident, it does not have a P in India, and the person is selling to person resident in India or by using IP address located in India of 2 crore or more, then the equalization levy of 2% will be collected by this entity and will be paid to the government of India. Okay, so this is what this question is all about. The next question, question number 6A, it's a theory question. It's a very strange and ajeeb kind of question. You can go through this theory question at your end. I'm not interested in discussing a theory question over here in my adjustments here. Here I'm more inclined towards what? Towards the adjustments of the important sums rather than discussing the theory portions. Next one is, there are two persons, Mr. Vikas, Mr. Vansh. Both of them are earning a salary of 13 lakh rupees. One of them is paying a housing loan interest of 2,20,000 self-occupied property, and another is paying 24,000 rupees medical insurance for himself and his wife. Now we need to identify which option is better for them, whether they should go for 115 BSc or whether they should go for otherwise. You have to make two calculations for both of them. Suppose if you are making normal calculation, not as per 115 BSc, then both of them will take salary as 13 lakh rupees and then 50,000 standard deduction they will take. Then Vansh will take 2 lakh rupees as deduction, not 2,20,000. 2 lakh deduction as interest house property, and he can set off against the salary income. Next, and Vikas can take 24,000 under chapter 6A 80D mediclaim deduction. Okay, and then they will compute tax as per the normal provision. What about if they go for 115 BSc? If they go for 115 BSc, their tax rates will reduce. Definitely the tax rates will reduce, but they have to add back few things. First of all, both of them have to add back 50,000 standard deduction. Secondly, Vansh has to add back what? Vansh has to add back 2 lakh rupees interest which is he has claimed under house property. Self-occupied property interest is not allowed under 115 BSc. And Vikas has to add back what? 24,000 80D chapter 6A deduction deductions are also not allowed. Most of the chapter 6, 1 or 2 chapter 6 are allowed. Apart from that, most of the chapter 6 deductions are not allowed under 115 BSc. After that, you compute the tax, whichever is more beneficial, you go for that. Now, the last question is exactly similar to the question which we have at least discussed 2 to 3 times in the earlier attempt RTPs and MTPs, which you have gone through. See that cost plus method question with the same 4 adjustment. So, I'm not interested in this question here. Please check it, please. So let's move ahead with one last one, that is May 2023 paper. After this, I am committed. I have completed my commitment towards you all regarding the compilation of all the papers up to the date for your November 2023 exams. Okay. So let us start with the first question of May 2023 paper. It's a long paper. It will take some time to discuss this paper, but nevertheless, we'll try to complete as fast as possible. First of all, the question number 1 is on total income. The assessee is a manufacturer, and therefore we need to see if 115 BAA or BAB is applicable. No, we are not supposed to follow 115 BAA and BAB. You are supposed to just compute total income as per the normal provision. Okay. Therefore, the very first adjustment is you are paying some extra amount, excess amount to your sister concern, and the fair market value is only 52,000, but you are paying 1,60,000 in cash. So you are doing violation of 48(2) also, and you are doing violation of 48(3) also. So first of all, I have also always told you this in class that if the provisions of 48(2) as well as 48(3), both of them are violated, then you have to apply first 48(2). Therefore, apply 48(2) and disallow the excess amount, and then apply 48(3) and disallow what? The excess amount of, if the balance amount is more than 10,000 rupees. Okay. So first of all, disallow 48(2), and then if the balance is more than 10,000, you have to disallow 48(3). Okay. Next, there are some repairs which you are doing for plant and machinery for replacing the worn out parts of the machinery. So will that be allowed as a revenue expenditure under section 31? Yes, it is allowed as a revenue expenditure because this does not bring any existence of any new asset. If you do such a repair which is leading to a new asset, which brings existence of new asset, then in that case, it is not allowed as a deduction. Okay. Next one, till last year, the company used to include interest as a part of its stock. But from this year onwards, they have changed this particular thing and they have excluded interest from the stock valuation, opening and closing stock. So actually speaking, you should not include interest as a part of your stock. Interest should never form part of the stock. So in the current year, the company is doing the things correctly, and they have given the effect also of that particular thing in the P&L account. So if everything is done correctly, why we have to do anything effect over here? Why will we give any effect over here? Because the company is correcting its mistake in the current year, and they are reflecting that particular thing in the P&L account also. Therefore, there is no need to do anything over here. There is one of the employee of the company, that is one executive of the company, who went on a business trip and he died because of some reason on a business trip. And therefore, the company, as a measure of humanitarian ground, the company is helping his family by paying some voluntary amount to his family. Therefore, that will be allowed as a business expense under section 37(1) because the employee was on business trip. Okay. Next one, there is some capital expenditure of family planning which is incurred by the company. Therefore, capital expenditure of family planning is only allowed 1/5. Therefore, 4/5 will be added back to the PGBP income. Okay. Next one, there is some retrenchment compensation which are paid to some of the employees for closing down of one of the unit of the company. So that is allowed as a PGBP expense under section 37(1). Don't worry about it. Okay. Next one is a very, very intelligent point. There is a cooperative bank. Okay. There is a cooperative bank from whom we have taken some loan. Now, that bank is waiving that loan for me. I have taken that loan for what purpose? You have taken that loan for working capital requirement. So I have taken a loan of 4 lakh rupees from a cooperative bank for working capital requirement. Now bank is waiving that loan. Now this will be deemed income under section 41 subsection 1. Why? Because it is a remission and cessation of a trading liability. Because I am taking the loan for working capital purpose. Therefore it is deemed income. Now apart from that, they are also waiving interest of 1 lakh rupees which is outstanding. Now this will not be taxable. Why? This will not be taxable. Why? Because this 1 lakh rupees, was it allowed as a deduction earlier? The answer is no, because as per 43B, this 1 lakh rupees will be allowed as an expense under PGBP only if it is paid, and this was not paid because it is outstanding. Therefore, when it is waived off, it cannot be taxable, because when it was accrued, it was not allowed as deduction. So when it was waived out, at that time also it should not be taxable. Therefore, you will remove this 1 lakh rupees from your PGBP income. Okay. Next one, you are contributing the employer is contributing some amount to the employee's pension scheme. Now that is allowed as a PGBP expense, but only to the extent of 10% of the salary. Salary means basic plus DA in terms. Therefore, here you are paying 12% of the salary. You will not be allowed 12%. You will be only allowed 10%. Therefore, 2% will be disallowed. 2% will come to how much? 50,000 rupees if you make up backward calculation. Next one, mark to market loss is allowed as a deduction provided it is computed as per ICDS. Now ICDS says that if you incur mark to market loss for unsettled derivative contract, it is not allowed. Therefore, because ICDS 1 says that unsettled derivative contract is not allowed as a deduction as per ICDS, therefore this mark to market loss will be disallowed under the income tax law. Next one is a very routine adjustment whereby the actuarial valuation is 4 lakh rupees. So the provision for a gratuity will be added back, and the actual gratuity which is paid to the employee will be allowed as as a reduction under PGBP. Next one is also a very, very simple adjustment. There is a company in which another company has 16% voting rights. That is, one company holds more than or equal to 10% of the voting rights of the other company, and both the companies are closely held company. So if I invest in a closely held company and if I receive what? If I received a loan from that closely held company, then in that case it is deemed dividend under section 222E. But the deemed dividend cannot exceed how much? The accumulated profits. Therefore, even though I am receiving loan of 4 lakh rupees, my deemed dividend cannot exceed how much? 1 lakh. Therefore, deemed dividend will be how much? 1 lakh rupees. Next, I am giving some benefit or perquisites to some of my customers or to some of my distributors, so on and so forth, as a matter of what? Business promotion expenses. Therefore, what I am giving? I am giving some phones. I am giving 5 sets of phone to 5. I am giving phones to 5 different distributors, and each of them costing 60,000 rupees. Therefore, total perquisites and benefit which I am giving is around 3 lakh rupees. Now, on that, I should have deducted TDS under section 194R at the rate of 10%, a very recent amendment. But I have not deducted the TDS as it is written in the question. Therefore, 30% of this 3 lakh rupees will be disallowed under the PGBP for not deducting the TDS. Okay. Last but not least, I am making some payment of what? A donation to certain electoral trust which is made by RTGS, and therefore it will be allowed as a deduction under 80 GGB. You can check it over here. So it was a simple question except 1 or 2 adjustments which was slightly tricky. Apart from that, most of the things were very simple in this question. Now pay attention please. Let's move on to the next question. The next question is also very, very simple question. Mr. A is aged 34 years. He is a salaried employee. Okay. Now, he is earning a salary of 23 lakhs. So, from that, first of all, he will get 50,000 standard deduction because he is not following 115 BAC. You can check it over here. Now, he has a business loss of 4,50,000 that he cannot set off against this. Therefore, he has to carry forward. He has a capital gain loss of 3,60,000 that also he cannot set off against salary. Therefore, he has to carry forward. Apart from that, he is also selling some bitcoins, or you can say virtual digital asset. Therefore, the selling price of virtual digital asset is 1,300 and the cost of the virtual digital asset is 1,000. So, 300 rupees is the profit multiplied by 1,000 quantity. No deduction of transfer expenses is allowed for virtual digital asset as per section 115. Therefore, here you are not going to get what? Any deduction of what? Virtual digital expenses on transfer. Only cost of acquisition is allowed. Therefore, 1,300 minus 1,300 is directly taxable at 30%. Sir, can I set off these losses against this income? Not allowed, not allowed, not allowed. That is directly taxable at 30%. These losses you cannot set off against salary also. These losses you cannot set off against the Bitcoin income also. Both of them have to be directly paid as a tax. Okay, just check it once. Let's move on to the next question. The next question is on section 9B and section 45.4, both of them combined together. There are 3 partners, L, M and N, and one of the partner, that is L, is retiring on 27th of July, and when he is retiring, his capital account is showing a balance of 20 lakh. There is no revaluation of asset in the books of accounts at any time when the L joined as a partner. Okay. Now, what is L getting on retirement? L is getting some cash payment of 1 lakh, some stock in trade, and then he is also getting some land at quota. Okay. Now, first of all, we'll apply section 9B. When is 9B applicable? 9B is applicable if the firm gives to partner stock in trade, or if the firm gives to partner what? A capital asset. Okay. So, first of all, the firm is giving to partner stock in trade. The stock in trade is how much? The value of the stock in trade is 2 lakh. You have to take the fair market value of the stock in trade, compare with the cost of the stock in trade, which is 1,20,000. Therefore, 80,000 will be what? The PGBP income, which will be subject to 31.2% tax in the hands of the firm. Okay, be very careful. The second thing is, which the firm is giving to the partner as an asset, is a capital asset, land at quota. Now, the FMV of the land, the FMV of the land is 17 lakhs. So, you will take that as a sale consideration. Then, the cost will be the actual cost or FMV as on 1/4/2001, whichever is higher. Therefore, you will take whichever is higher multiplied by current year indexation divided by 100. That comes to 13,35,900. And this is long term, and on long term capital gains, you are going to pay 20.8% tax. So, these are the 2 taxes which you are going to pay under what? Under section 9B, one for stock in trade, one for capital gains. Now, coming to what? 45.4. What is 45.4? 45.4 speaks about reconstitution of the firm, and it is applicable if the partnership firm give to the partner money or capital asset. Therefore, B is money, C is capital asset, and D is the capital account of the retired partner. So, B is money. How much money the firm is giving? The firm is giving 1 lakh rupees. Therefore, you will take 1 lakh in B. C is the fair market value of the asset which is received by the partner. Therefore, how much is the capital asset which is received by the partner? Only capital asset is covered in what? Now, 45.4. 45.4 does not talk about what? Stock in trade. Therefore, here you are going to take 17 lakh as its what? Capital asset. Now, what is D? Now, the most important point over here is D. Before computing D, whatever profit you have earned, whatever book profit you have earned under 9B, you have to allocate that book profit after tax to all the partners. That is a very important step that you are not going to forget. Okay. First of all, what is the book profit? What is the accounting profit on transfer of land? Now, the transfer of land, there will be no accounting profit because the land in the books was 17 lakhs and the land market value was also 17 lakhs. Therefore, there will be no profit in the accounts on land. But there will be a profit on SIT in the books of accounts. How much? The SIT was 1.2 lakhs. It was recorded at cost of 1.2 lakhs. But when you transfer, you are transferring at 2 lakh rupees. Therefore, there is an accounting profit of 80,000 rupees in your books of accounts. Therefore, your accounting profit is increasing by 80,000. But at the same time, you are paying two taxes. One is on this 80,000, you are paying 31.2% tax as per 9B. So that you will take 24,960. And another, you are paying 20% tax over here on the capital gains of that quota land. That you will minus this. After I do this, I will get a loss over here instead of profit. So you will divide this loss between all of them in equal share, assuming that the share of profit of all the partners are equal. In the question, the share of profit is missing, so you can assume that all the partners are having equal share. Therefore, 74,276 goes to this retiring partner. What is the capital account of this retiring partner? 20 lakhs. What is the share he is getting? Loss of 74,276. So I will reduce this, I will get D, and then I will get the capital gains, which is chargeable under what? Under section 45(4). It's a very intelligent question. Next question is a very simple question. It's a repetitive question which has come many times in the exam, which we have done earlier also in a lot of papers. That is, there is a foreign company which is entering into an agreement with an Indian company to provide some assistance with respect to a power plant in Gujarat. What kind of assistance? They are providing some FTS services to Indian entity. FTS services, one is offshore service, another is onshore service. Offshore means they are providing the services from outside India with respect to Indian project. Onshore service means they are coming to India and providing services in India. It doesn't matter, yeah. In case of FTS, FTS is deemed to accrue or arise as per 917, whether or not you provide the services in India. It doesn't matter. Whether or not you provide, whether you have a business connection in India. It doesn't matter. The question is saying that foreign company does not have a business connection. It is not required for FTS. For FTS, for interest, for royalty, all these things are not relevant. Only thing is relevant is that services has to be utilized in India. Therefore, this 2 crore will also be taxable. This 3 crore will also be taxable. Now, how the consideration is discharged? This 3 crore is discharged to the other person through a bank account. Therefore, this 3 crore will be taxable as per 917. It is deemed to accrue or rise in India. How this 2 crore is discharged? This 2 crore is not discharged in monetary terms. In fact, we are giving them debentures worth rupees 2 crore. Therefore, that will also be taxable. We have done similar adjustments earlier also. Okay. Now, there is one hidden adjustment over here. On this 2 crore rupees, now the foreign company will also earn interest for 7 months. From September to March, they will also earn interest. Now, that interest will also be what? Deemed to accrue or rise in India. And you have to take that interest also in India and you have to pay tax on that also. Check it, please. Now, let's talk about the next question. Question number 3 is part 1. Now, this is the first question which is on charitable trust. There is a charitable trust who are giving some interest-free loans to employees. Now, the question is, if a charitable trust gives some interest-free loans to the employees, are employees covered in the specified person mentioned under 13.3? The answer is no. A specified person does not include employees. It does not include relatives of the employees. It does not include all these people. It includes author of the trust, founder of the trust, substantial contributor, etc., etc. These people are covered in what? In specified person. Therefore, if the trust is giving some interest-free loan to employees, it is not a violation of the provisions of the trust and the AO cannot withdraw the exemptions of the trust. Okay, check it, please. Next one is a very routine question which we have done so many times in our discussion. That is, there is one educational institution and there is one hospital. The annual receipt of educational institution is 2.4 crore and annual receipts of hospital is 2.5 crore. The aggregate receipt does not exceed 5 crore rupees. Therefore, there is no need to take any kind of approval for the purpose of claiming exemption. If the annual receipts, aggregate annual receipts is up to 5 crore rupees, there is no need to take what? Any kind of approval for the purpose of claiming exemption. Okay. Now, the next question is a very intelligent question. And in this question, you have to make some assumptions now. There are two assumptions that you are making. According to that, the answers will change drastically. The first assumption which we are making that this person is coming to India on 1st July 2022 permanently. Now, he is a resident. Definitely, if he is coming in July, he is a resident because from July to March, he will be staying for 182 days. But we don't have the data of the past year. Assuming that in the past years also, he has come to India and his stay in the last 10 years, in the last 7 years is 730 days. And out of the last 10 years, he is resident in at least 2 years. Therefore, we can make an assumption that he is a resident and ordinary resident. Let us answer according to that first. If a resident and ordinary resident, then world income will be taxable. First of all, his salary income of the first 3 months. First 3 months, he was staying outside India. April, May, June, he was staying outside India. From 1st July, he came to India. Because of his mother who was not well, so he came to India. He planned to shift it to India. Okay. Now, if he is resident and ordinary resident, then world income is taxable. This 3 month salary will be taxable. Yes, it is taxable. So 3 month salary 3250 into whatever is the average rate, 23 rupees will be converted. Okay. Then he has also rented some house property over there from July. From July, his property was rented. So his rental income will also come over here. So his salary is 9,500. Sorry, his rental is 3250. On that rental, he will get standard deduction of 30% also. Apart from that, profit from business will come. A bank interest come from country S, that will also come in the income statement. Income from saving bank interest from SBI will come in the income statement. then dividend income from India. These are all income which are accrued in India. All these things you will do. After that, you will also take chapter 6 deduction. 25,000 mediclaim you will take under 80D for himself because he is not a senior citizen, and for his parent also he will take only 25,000 because his parent is non-resident. Okay, if parent would have been resident, he would have taken 50,000 rupees. Because the parent is non-resident, sorry, therefore he will get only 25,000 rupees. After doing that, he will also take deduction of 80 TTA, 10,000 rupees, and then he will compute the average tax rate in India, and then he will compare with the average tax rate of foreign country. Whichever is lower, that much will be allowed as a relief. Now, another assumption which we can make is he is a resident. He is definitely a resident. There is no doubt about his residential status. He is definitely a resident, but the question is, we don't have the data of the past year. So we are assuming that he is resident, but he is not ordinary resident. If he is resident, but he is not ordinary resident, then all his income cannot be subject to tax in India. Then which income will not be subject to tax in India? The income which is accrued outside India, that is salary income, will not be subject to tax. HP income will not be subject to tax. And similarly, this FD income outside India will also not be subject to tax in India because these incomes are accrued outside India. In case of NOR, only incomes which are accrued or deemed to accrue or receive or deemed to receive in India are taxable. Or if the PGBP is done outside India and controlled from India, then only it is taxable. Otherwise, foreign incomes are not taxable in case of what? NOR. Accordingly, both the solutions are correct. Whatever solutions you will feel correct, you can do. You are not supposed to do both of them. Anyways, you don't have that much time in exam to complete the paper. Okay. Now, next question, we'll go ahead. Which is question number 4, which is on TDS. Now, it's a very, very good question. We have done this question earlier also. Mr. A is purchasing some scrap. Now, if you are purchasing some scrap, the seller will collect TCS. But if you give a declaration that I'm going to use this scrap for the purpose of what? Manufacturing or power generation, the seller will not collect TCS. So, you are giving an excuse that I'm going to use this scrap for what purpose? For manufacturing purpose. Therefore, here in this case, the TCS will not be collected. But you are exempted from TCS. The seller is exempted from TCS. But is the buyer liable for TDS under 194Q if the last year business turnover is greater than 10 crore? And Mr. A's last year business turnover is greater than 10 crore. Therefore, buyer will be liable for what? The TDS under 194Q because the sale purchase is also exceeding what? 50 lakh rupees. Okay. So, on 5 lakh rupees, 0.1% TDS will be deducted by the buyer. TCS is exempted, but TDS will not be exempted. If TCS would have not been exempted, then TDS would have not been applicable. But if TCS is exempted, you have to deduct TDS under 194Q. There is a CBDT circular on the same, okay, which we have done it in class. Next is, there is one person, Mr. P, who is providing some services to client, technical service, and on technical service, we know that we need to deduct TDS at the rate of 2% under 194J. But the client is giving a certificate under 197, lower deduction certificate, and saying that please deduct 1%. So I said that yes, I will deduct 1%. But unfortunately, later on, I came to know that the assessee is not filing the return of the last 2 years. And the assessee's TDS is also more than 1 lakh rupees. Now, do you remember that? If the payee is not filing the return for the last 2 years and the payee's TDS is also 50,000 rupees or more, then in that case, I am liable to deduct TDS as per 206AB. Now, what does 206AB says? 206AB says that twice the rate or 5%, whichever is higher. Now, what is the rate over here? The rate is the concessional rate is 1%. Twice of that will come to 2%. Compared with 5%, whichever is higher, will be liable for deduction at TDS. Therefore, I will deduct TDS at how much percentage? I will deduct TDS at 5%. It's a very, very intelligent question. Now, the third question is a very simple question. You are buying some house property. The price of the house property is 60 lakhs, whereas the stamp duty value of the house property is 82 lakhs. Therefore, TDS will be deducted at the rate of 1% on how much? On 82 lakh rupees. Check it, please. Okay. So, this is what this question is all about. Now, the next question is a transfer pricing question. It's an easy question, nothing great as such. There is a domestic company and there is a foreign company, Sumi INC. Both of them are associate enterprise. Sir, how did you come to know that both of them are associate enterprise? One entity is wholly dependent on the raw material of another entity. Now, if one entity is dependent on the raw material of another entity for 90% or more, if I am dependent on you for 90% or more of the raw material, then we both are what? Associate enterprise. Therefore, both of them are associate enterprise. Now, Shahi Private Limited is purchasing some goods of 30 crore rupees from its associate enterprise. Now, we need to find out the arm's length price of this 30 crore. Now, Sumi is charging us 20% margin, whereas Sumi is charging other unrelated party only 10%. So, they should charge us also 10%. Okay. So, what I am doing? First of all, I am removing the margin of 20%. I am removing the margin of 20% on cost. So, if it is 20% on cost, therefore, it is 1/6 on sales. So, I am removing 5 crore rupees or 5 lakh rupees, whatever it is from here. If I remove the margin, 20%, my margin, then I will get my cost. Then I will add what? Add the margin, which is arm's length margin. The arm's length margin is 10%, so I am adding 10%. Okay. So, first of all, I am removing the entire margin, making it at cost, and then I am adding what? The genuine margin. The genuine margin is 10%, so I will get the actual price. Okay. After that, the Sumi is also providing me some additional services for which the Sumi is allowing me to use the brand name of Sumi INC. So, for that, Sumi will charge me extra amount here. How much extra they are charging? They are extra charging 0.9 crores, that is 90 lakhs. So, I will add that also to my cost. Therefore, effectively, my cost will come to how much? My arm's length price will come to 28.4. Whereas, I am purchasing at how much? At 30 lakh rupees. So I am paying extra 1.6 lakhs. This will be added back to the income statement. Okay. Now the second question, if the TPO enhanced the income, if the TPO enhanced the income by 2 crore rupees, can I claim deduction of 10 AA on that 2 crore rupees? No, not allowed. As per first proviso to section 92C subsection 4, if the assessing officer increases or the TPO increases your income, then on that increased income, you are not eligible to claim 10 AA or chapter 6 deduction. You are not allowed to do that. Okay. Next, if there is an underreporting of income because of the transfer pricing officer, will I be liable for penalty? Yes. If you do not report your income properly in the income statement, then the TPO will impose what? The TPO will impose 270A penalty, that is misreporting. 200% penalty will be imposed on the assessee. Okay. So this is what this question is all about. Next question is on case law. There are 3 case laws over here, which I will address you one by one, all of them. There was an assessee on which there was some genuine hardship because his money was stuck with debtors. His large funds were stuck with debtors, and some of the funds were also stuck with the income tax department in the form of refund. Now what mistake assessee did? Assessee, while making the payment to one of the party, deducted the TDS but did not pay the TDS on time. But assessee after some time deliberately paid the TDS along with the interest before he received the notice from the income tax department. So assessee has done everything correct before receiving the notice. Is it justified to put the assessee under jail? Is it justified to put prosecution proceedings on the assessee? And the court said that the answer is no. There was a genuine reason for not paying the TDS on time because the assessee's funds were stuck. The assessee's funds were stuck with the debtors, stuck with the income tax department, and assessee has paid the tax before the department sent the notice. Assessee has so much to pay the interest also before the department sent them the notice. Therefore, there is no reason to charge what? Prosecution proceedings on the assessee. Okay. Next question is on Reliance Telecom Limited, whereby the powers of the tribunal order is discussed over here. Thus, tribunal has the power to, after passing the order, to call back the order and re-hear the entire order. The answer is no. The tribunal does not have the power to call back the order and re-hear the entire order. The tribunal has the only power to bring the order, to call back the order and rectify an apparent mistake if there is an apparent mistake within the time limit. That too within the time limit. The tribunal cannot bring back the order, call back the order and re-hear the entire appeal once again by reconsidering the entire matter once again. That is not possible. Okay. Next, last but not least, there was an assessee on whom there was some MAP proceedings which were pending. What is MAP proceeding? MAP is a mutual agreement procedure which is pending at international level between 2 countries. Now, because the MAP proceeding is pending, the assessee is saying that the department should waive my interest under section 220A. Is it justified to waive the interest under 220A just because a MAP proceeding is pending at international level? The court has said in the case of Pioneer Incorporation, USA, that it is not justified to waive your interest under 220A just because a MAP proceeding is pending against you. Just because a MAP proceeding is pending, that does not give you the right to tell the department that waive my what? Interest. That is absolutely a bullshit point, because then everybody will do what? Everybody will initiate a MAP proceeding with higher authority, with international authority. And once you initiate that, deliberately you will initiate that MAP proceeding. Once you do that, then the department will be forced to what? Forced to waive the interest. Everybody will use this as a tool. Therefore, the department said that that is not allowed. The court said that that is not allowed. Okay. Now, the next question is a very intelligent question where ICI has again taken 2 different alternatives. First of all, they are solving this question as per equalization levy. Secondly, they are solving this question as per income tax act. Sir, which one is correct according to you? According to me, the second one is correct, because the question is very clear, which is saying that you should solve as per income tax act, not as per equalization levy. Okay. But they have done it as per both the cases. Now, there is one company, Kiwi Inc., which is a company which is based in USA. They are engaged in manufacturing and selling of mobile phones globally. There is another company, Alpha Inc., which is engaged in managing a website. It is working like Amazon. Okay, they are also engaged in hosting advertisement. There is another company, Gamma LLC, which is incorporated in UK, and they are engaged in manufacturing and selling printers. Now, we are talking about Kiwi Inc. First of all, Kiwi Inc. is selling 80,000 mobile phones. So, first of all, I am discussing the point as per equalization levy, the way ICI has done. Now, in first case, equalization levy is applicable because you are selling to persons resident in India. Therefore, 2% equalization levy will be applicable as per Finance Act 2020. 15,000 into $2,000 into 80 rupees is the price of dollar over here. You have to multiply that. If this amount is exceeding 2 crore rupees, equalization levy is applicable, and it is exceeding 2 crore, you can check it over there. Okay. Second thing, in second case, equalization levy will not apply because you are not selling to persons resident in India. The primary condition is that you should either sell to person resident in India, or to person non-resident in India in certain specified circumstance, or to any other person using IP address in India. These are the 3 circumstances in which equalization levy of 2020 is applicable. In third case also, equalization levy will be applicable because you are again selling to the resident of India, and if you multiply 7,000 into 2,000 into 80, you will get more than 2 crore rupees. Therefore, again equalization levy is applicable. In the fourth case, it is not applicable because again you are not selling to the residents in India. You are selling to the residents in UK. In the fifth case also, it is not applicable because the sale itself is done outside India, because the physical store is outside India. The physical store is not in India. The sale is done outside India. Okay. Apart from that, There are two more transactions which are over here which we need to talk about. First is there is some transaction of 50,000 rupees which you have paid for hosting advertisement for targeting Indian customers. Is this covered in 2016 equalization levy? 2016 equalization levy will not apply. The reason is very simple. Because for 2016 equalization levy to apply, the payer who is in India has to be resident or a non-resident who should have a P in India. Either of the two has to be there in India. Here, the person who is paying the amount is not a non-resident who is having a P in India. The person who is paying the amount does not have a P in India. Therefore, 2016 equalization levy is not applicable. 2020 equalization levy will be applicable. The reason is because they are targeting the Indian customer. In second case, even 2020 equalization levy will not be applicable because there they are targeting the UK customer. If you are targeting UK customer, equalization levy cannot be made applicable. This is the one of the way to solve this question. Another way in which institute has solved this question is by considering this as what? As a business connection. We know that there is an amendment which is made under business connection which is applicable from AY 22-23 which says that if there is a significant economic presence in India, then it is also what? Subject to business connection and income is deemed to accrue arise in India. And what is significant economic presence? If a non-resident is entering into a transaction with a resident for sale of goods, for services, for download of data, etc., and the payment is more than 2 crore rupees, then significant economic presence is attracted. So the condition is the non-resident should enter into a transaction with a resident and there has to be a more than 2 crore rupees payment. Therefore, in the first case, there is a significant economic presence because the transaction is with resident and the payment is also more than 2 crore. Significant economic presence is applicable. In second case, it is not applicable because you are entering into a transaction with non-resident. In third case, it is applicable because you are entering into a transaction with resident and there is a more than 2 crore rupees payment. In fourth and fifth case, also not applicable because in fourth case, you are entering into a transaction with non-resident and in fifth case, you are entering into a transaction which is done outside India that has nothing to do with income which is accrued in India. That is just absolutely done outside a physical store outside India. That is never going to be accrued in India. Okay. Last but not least, do you remember that in business connection also there was one amendment that if there is a sale of advertisement by one person to another person by targeting customers in India, then that is also taxable in India. That is also deemed to accrue as in India. Therefore, this 50,000 will also be deemed to accrue as in India under section 911. But this $20,000 will not be accrued in India because here we are not targeting the Indian customer. Okay. So this is what this question is all about. You can solve by either of the way. You can go through the solution once at your end if you want. Okay. Last but not least, one last question is there over here. Which is on SFT. So whether SFT is liable to be filed by the reporting person or not, we need to decide that as per 285BA. One person, Mr. A, is going to a State Bank of India and buying 5 FD of 3 lakh each through his current account. SFT not applicable. Yes, if you buy an FD of more than 10 lakh rupees in cash, then SFT is applicable. Here the person is buying FD bank draft in what? In through current account. Therefore, SFT will not be applicable here. Okay. Next question. There is one person who is going to Canara Bank and buying an FD. Time deposit means FD or RD. He is buying a time deposit of 7 lakh rupees and is renewing a time deposit of 5 lakh rupees. Therefore, SFT is not applicable. Why, sir? What is the provision? The provision says that if any person goes to a bank and buys a fixed deposit, recurring deposits of more than 10 lakh rupees in a financial year, other than renewal, the renewal point will not come over here. Therefore, other than renewal is how much? Other than renewal is only 7 lakh rupees, which is less than 10 lakh. Therefore, here also the SFT provisions are not applicable by the Canara Bank. Okay. Next one for credit card. For credit card, when credit card companies are liable for SFT, they are liable if the aggregate credit card payment by a person in the entire year is more than what? Is more than 10 lakh. Or if the cash payment in the entire year is more than 1 lakh. Now, in this case, if I do the aggregate cash payment, first and the third transaction, this and this will be multiplied by 4, this will be multiplied by 3 because this is for 4 months, this is for 3 months. So the cash payment is exceeding 1 lakh rupees definitely. So therefore, in the first transaction and the third transaction, I am liable for what? I am liable for the SFT reporting. But for the second transaction, I am not liable because that is made through bank. And if I am making the payment through bank, then the aggregate limit should exceed how much? It should exceed 10 lakh rupees. And that is not exceeding. Therefore, in the second case, there is no reporting requirement. But in the first and the third case, there is a need for reporting. Last but not least, every person who is liable for tax audit and if they receive more than 2 lakh rupees in cash, if I am liable for tax audit and if I receive more than 2 lakh rupees in cash, then I am liable for what? I am liable for what? SFT reporting. But in this case, I am liable for tax audit, but I am receiving exactly 2 lakh rupees in cash. Therefore, in this case, there is no need for what? SFT reporting in my case. After this, whatever question is there, that is a theory question. You can go through it once if you want. And that's it from my side, whatever I could have done for you all. So in all, I have completed my commitment. I'm tired now because it's not that easy to speak so fast, especially in English. I'm not used to talking in English so much. I'm generally used to talking in Hindi only. But nevertheless, this thought always comes to my mind that there has to be someone to help you all. There has to be someone, the language should not be a barrier for any of my students across the country. Whatever little bit knowledge I have, if I'm giving that to my North Indian student, West Indian student, East Indian student, then you guys of South India equally deserves that. Whatever little bit knowledge I have, I would like to shower it to all of you, which I have tried my best through my revision videos, through my RTPs, through my MCQ videos, through my case scenario MCQs, all the RTPs, MTPs, compilations, ABC analysis, whatever I could have done it for you all, I have done it for you all in English also, to the extent it is possible. If I have done any mistake from my side, please forgive me. So in all, we have done a compilation of, we have done a very gigantic work. We have not done a small work. We have done a very, very, very great and big work of compiling 23 papers. Till May 23, I have already put a compilation of 19 papers and now 4 more papers. So you are up to date with all the latest RTPs, all the latest MTPs of last 6 to 7 attempts, all the exam papers of last 5 to 6 attempts. You are up to date with all of them. 23 papers are there in front of you. And you are, guys are blessed. Blessed because you are getting 2 days holidays for November 2023 DT exams. So I request you all to go through all these videos at least twice. And I request all of you to please share these videos also with all your South Indian friends. Don't be selfish in life, okay? Share it with all of you, with all the close friends, nearest and the dearest one. Even if the friends are not close, they are distant friends, we have to share it with them. For me, you have to make it spread. You have to make this viral amongst all your friends so that maximum students are getting benefit because of that, okay? So that's it from my side. Whatever I could have done, I will be available on my Telegram channel for both the days before the examination for addressing all your doubts. So whatever doubts you guys will be having, you can ask me over there during the exams. Okay, take care till then and all the best for your exams. Take care all of you. Bye.